This spring, Goldfields announced it planned to acquire Yamana for $6.7 billion. Goldfields CEO is Griffith. Chris, welcome to Kitco.
Hi, Michael, and a great pleasure to be talking to Kitco Mining today.
Can you describe this deal? I believe this is heading to a shareholder vote in the fall.
Yeah, so perhaps let me describe what the deal is. So as you correctly point out, this is a $6.7 billion all-share acquisition for Yamana. So at the time, we agreed to an exchange ratio of 61:39. The exchange ratio was locked in. And really what we are buying is a world-class portfolio of assets, not only 5 operating mines, but also a suite of assets and a suite of opportunities that come with those, diversified across premier gold jurisdictions, bulking up our South American business, getting us access into Canada with this deep project pipeline. So a great opportunity for us. So where we are is that we will be providing the circular probably sometime in September, end of September, and then shareholders will vote roughly a month thereafter.
Explain what the circular is, Chris.
So circular is just we put all the detail of why we've done the deal, the way we've made up the deal. So it's really the essence of the deal. So both Yamana do that and so do we. So it's really giving both sets of shareholders all the information they're going to need to be able to form an opinion of whether to vote in support of the deal or not.
Talk about the operations itself. What would you like to highlight if the acquisition goes through?
I think one of the things that make this deal unique is that it has true operational synergies. It's properly got a logic that fits together. So if we look first of all at the type of geology so the type of ore bodies that we're mining in Yamana, every single one of them is replicated in some form in Goldfields. In the mining methods, every single one of the mining methods in Yamana are replicated in Goldfields. So it is a true fit of assets that work well together. The jurisdictions work well together. We bulk up in South America, as I mentioned a bit earlier, in a jurisdiction that we've got a very light footprint. So the Yamana footprints properly bulks up that region, very much similar to what we have in Australia. And then we also, as I said, get access into Canada. So what this does operationally is that we bring, as a company, we've been around for over 130 years, we bring both a bigger balance sheet, a greater scale company, and the operational excellence that we have within our company. We can add that to already the good work that's happening in Yamana. And overall, this is where you see 2 sets of assets where the sum is greater than the sum of the parts. So, we truly believe in the type of ore bodies that we're mining, in our capabilities, our exploration capabilities, and the balance sheet that we will be able to unlock substantially more value of the Yamana assets in the combined portfolio than that company would be able to do by itself.
There has been some opposition to the deal, Chris. I was thinking of Redwheel, that was one of your largest shareholders, that according to Reuters, they were saying, stick with your brownfields that you have in your development projects right now. How are you doing right now in turning around shareholders and telling the story about why this deal works, Chris?
Yeah, I think there were 3 main areas of concern from shareholders, and I think it's absolutely fine to acknowledge that shareholders are never going to, on day one, have the same level of insight that we have had, both sets, both Yamana and ourselves, after 7 months of due diligence, are going to have a much deeper insight into the value to be created, the value to be obtained by putting these companies together. So I don't think it's unexpected to hear shareholders on day one saying, we don't understand the strategy, we don't understand the timing, and we don't understand the premium. So in the first round of engagement that we've had with shareholders, I think it was spent explaining to shareholders the just the strategy behind the deal. Because Goldfields is in a really good position at the moment. So the company's in good positions, had outperformed the gold industry in terms of shareholder return in the last 5 years. And we still have further growth of another 20% over the next 3 years. So a lot of shareholders are saying, but that actually sounds like you're in a very good position. Why do you need to do something else? So we've spent time helping shareholders understand that that's exactly the point, is that we are looking to the next phase of our strategy, to create options to both replace declining production that we have in our own portfolio and building a portfolio for further growth. So the reality is, after we've executed this range of growth that we now come with Salares Norte in Chile, we actually have very few internal opportunities left beyond that. So this is looking for, as some of our assets start declining over the next few years, we actually don't have the internal opportunities available. And so what this is doing is, from a position of strength, starting to look for the next wave of strategy for the company. So this is positioning what we believe is Goldfields exceptionally well for the next 10, 15, 20 years off a position of strength. So shareholders are starting to understand the strategy. They're starting to understand the timing, that this actually is a relatively good time before the competition for assets really, really hots up, that we're probably stealing a march on a number of our competitors out there. So I think that's starting to land well. We then did a market update now about 3 weeks ago or 4 weeks ago, and then subsequently spent what we sort of call round two of engaging with shareholders. And that's really now to help shareholders start understanding the value that we could see. So yes, we're paying $6.7 billion, or that's what the exchange ratio was based on. Of course, with the recent fall in the market, that number is quite a bit smaller. But we're helping shareholders try and see the value that we can see that is way beyond the value that we are paying. Also, what we are doing is helping shareholders understand that the other alternatives that are often spoken about, well, why don't you just go and buy these assets? Why don't you go buy individual assets and build them yourself? We're starting to help shareholders see that actually this combination of assets that we're buying is a much better collective suite of assets than going to buy and develop individual assets that are often priced substantially higher than the price that we're paying, the total acquisition cost for the Yamana assets. So, it's taking a while. It probably will still take some time. I think the next big feature is what we spoke of earlier, and that's the circular. And beyond the circular, we'll have another opportunity to engage with shareholders once they see more tangible, perhaps more detail of why this deal was put together, how it was put together, what the value is that we can see. Shareholders will start, I think, having sort of a third round. And post that, I think we're confident that we can get shareholders to vote in favor of this deal.
You mentioned the word consolidation, and it's been something that analysts have been asking for a long time in the precious metal space. Why do you think it's just beginning? Why do you think it's something that you have to get ahead of?
Well, I think, to be fair, over the last sort of 3 years or so, there's been quite a bit of consolidation in the gold space. So this is not unique. In some cases, sort of two equally valued companies have been able to put together in what is called a merger of equals, where there hasn't needed to be a premium paid. And generally, that's sort of what most people say, well, we like those deals. But in reality, some of the other deals that have been done have needed to pay a premium for differently valued companies, because there's no particular reason why one set of shareholders will say, hey, we'll sell our company to you at a big discount. There's no need for them to do that. So yes, there have been deals done in the last while, but our view is that there will be substantially more consolidation in the gold space. In the past, I think, there's been an ability through exploration for companies to replace their declining assets and their declining resource and reserves. What we've seen over the last, let's say, five years or so, or maybe even a bit longer, is that the return for exploration is rapidly diminishing. So we're not seeing a reduction in the exploration dollars. What we're seeing is a reduction in the return for those exploration dollars. So we're just not seeing the discoveries. Where we are seeing the discoveries, they're coming in at lower grades, and they're coming in at less favorable jurisdictions. So if you extract out of those discoveries where the really good jurisdictions have been and the good discoveries, you see there's actually very, very few, and therefore the price that is being paid for those is substantially higher than what we are doing. So that's the reason where the bigger gold companies no longer have the ability to replace their declining reserve and resource base internally. They're having to go externally. And the competition for those external options is becoming really intense. And that's why the price for good assets in good jurisdictions is becoming so high. And that's actually why we believe that the consolidation that is necessary in the industry, but between Gold Fields and Yamana, is such a good deal, because the logic of the fit between the two companies is so amazing, and relatively speaking, the price that we're paying is relatively low in comparison with the price that is being paid for other combinations. So there will be an increasing amount of consolidation, we believe, and at higher prices going forward, and that's why we continue to believe that the Yamana acquisition is a great acquisition for Gold Fields.
Chris, I want to turn to some operational questions. You stated some of your renewable power initiatives at the Digger and Dealer presentation as you work towards 2030 emission targets. How realistic is it using wind and solar to supplant oil and gas for power at mines?
Yeah, so I mean, that's not going to happen overnight. But the one thing that Gold Fields has been is at the leading edge of mining companies actually implementing renewables. So we've started this journey since 2016. We have 3 of our Australian mines already have very significant amounts of renewables. We're now putting in place, as we speak, another very big mine in South Africa where we've got a 50 megawatt solar plant. So these are massive investments, and all of them actually have been NPV positive. So that means that they are generating a profit for us for the capital that we're investing. So I think that the first wave of wind and solar, I think is not difficult to see that will generate returns and it'll be easy investments. Whether or not that can reduce the base load will depend on whether we can get storage. So, for example, at South Deep, the solar plant that we're putting in place will only be about 20% of the overall power for that mine. For us to put more solar in place, we will have to have an ability to store that power so that we can use it on the off cycles when the sun isn't shining. That component is work in progress and is not quite there yet for cost competitive storage. What then works best is if having a component of wind with your solar, and we have done that now very successfully at Agnew in Australia, where we now have 60% of the power for that mine is coming from renewables. There's a small component of storage, but the combination of wind and solar there does work, that we actually can use some of that as baseload power and not just a nice to have component where some of the power is used by renewables. So I think there's enough of the low-hanging fruit for us to invest in now. We're all investing in storage of some sort. and acknowledge that to take away some of the dependence on fossil fuel generating power, you need to have a combination of wind, solar, in some cases gas, and storage. And we already have one mine that has already gone that way to have a component of all four of those. As we finish the investment in this 50 megawatt at South Deep, we're going to be looking at both storage and wind. So I think we on the journey, Michael, and I think as long as we continue investing along that journey, by the time 2030 comes, we'll be able to achieve our target of 50% absolute reduction that we have been communicating now for some time, and we are very well on our track. This is not just talking about some of these things. I think what Gold Fields has been able to demonstrate is that we have actively been investing in and getting the benefit of those, what we think was ahead of the curve investments in renewables in mining companies. We've got a lot of other great examples. Probably don't have time to talk about that, but for example, in Peru, we are now 100% on hydro powered electricity. So we actually have, for our primary source of power, zero emissions from our mine in Peru. And as Solaris comes up, the mine in Chile, we'll be investing in both wind and solar. So all of our operations have got renewable plans associated with them. And then probably a little bit further down the track is cost competitive investment in zero emission vehicles.
Chris, are there any fuel cell trucks out there, or is it all battery driven? I ask since, due to your past platinum experience at Anglo American.
I think that the future is going to be a combination of battery, there will be components where batteries work. Generally, I'm absolutely of the view that fuel cell vehicles are actually better solution for large vehicles than batteries are. I think the work that is underway, you look at the work that's underway with FMG, Anglo American. The reality is that actually fuel cell trucks exist in the world on roads. One of the challenges for fuel cell vehicles on long haulages is the hydrogen supply, not the fuel cell technology. So putting that fuel cell technology into mining vehicles where they can come back to a central point to be refueled, I think is an absolute ideal solution. We're probably still a little bit away, but you're seeing mining companies actively investing. We're seeing both original equipment manufacturers for mining equipment, but also for trucks. So big trucks worldwide are investing in fuel cells. I think the more the industry does is investing in all of these options, we're going to come up with a more ideal solution going forward. We as Gold Fields are investing in battery vehicles, light vehicles, those LHDs as well as trucks. But I think we're looking to some of the bigger mining companies, perhaps to do some of the more heavy lifting on fuel cells. But I'm absolutely 100% behind that technology. I think without a doubt, in the next few years, you're going to see fuel cell vehicles on mines, both on surface and underground.
Chris, thanks for speaking with Kitco.
Yeah, thanks very much, Michael. It's a great pleasure to talk to you.
He's Chris Griffith. He is CEO of Gold Fields. My name is Michael McRae, and you're watching Kitco Mining.